let's just start with what Lisa mentioned about 30 minutes ago. What do you think is more important this week, the Chairman Powell address or the data in the labour market?
I think both are equally important. We're going to get from the labor market increased evidence that there is a slowdown in the labor market in the U.S. It's not yet visible in a broad basis in terms of the latest data that we've had. We've seen a slowdown in the pace of hiring, but it's still positive. I would expect that as we move into 2023, we're likely to see a bit of a turn in sentiment and increased evidence of layoffs, so pullback in the labor market, but it's not quite evident in the data yet. Powell's speech will also be important because right now we have this paradox where markets are pricing the Fed to go probably as high as 5% with the Fed funds rate, but implement a couple of rate cuts on the back end of next year. The Fed wants to lean hard against that narrative. It wants markets to believe that it will go to 5% and potentially higher, but then more importantly, hold at that level over the course of 2023. That's not currently priced into markets.
How do you think that's going to get picked up in the projections from the Fed on December 14th, Greg? I'm not just looking at unemployment, I'm looking at growth too. They've got unemployment in 23 at 4.4%. They have growth in their last set of projections for 2023 at 1.2%, and that is way above some of the projections I'm seeing on the street, Greg. What do you make of that divide?
Well, I think what the Fed wants to do right now is switch from a speed paradigm to a destination paradigm. So it's going to want to indicate that it will reach a higher terminal Fed funds rate, higher than the 4.6% that was in the September economic projections, and look at a Fed funds rate that's likely to be higher than 5%. But at the same time, the Fed is likely to indicate that it will tolerate an unemployment rate that rises perhaps above 5%, a growth that will likely be weaker, if not slightly negative over the course of 2023, and generally an environment in which we're going to have a likely recession. As you were telling us right before this, we are in a highly uncertain global environment. And I think we have to be careful and humble about the fact that there is that tremendous uncertainty as to the direction of the U.S. economy and of global economies overall, because a global recession is generally larger than the sum of its parts. So if every economy, every large economy around the world, China, Europe, and the U.S. are heading into a recession, that's likely to pull global activity, and that's a downside risk to economic activity overall.
Regardless of the nature of when we get the recession, do you expect this to be a short and shallow, the way that a lot of people have been talking about, or do you expect this to be a more prolonged downturn?
Truth is, we really don't know, Lisa. I mean, we are in an environment where there's a tremendous amount of uncertainty regarding the global economic outlook. I've talked before about this hat trick of forecasts in the context of the World Cup, but we have a consensus that there will be a recession, that it's likely to happen in the very near term, and that's going to be mild and shallow. I mean, if that were to happen, that would be the hat trick of forecasts for forecasters, but we don't know. I mean, there is certainly upside risk in terms of the resilience of the economy today. We still have a labor market in the U.S. that's adding a decent number of jobs. We still have consumers that are spending, but spending at a slower pace. And we still have this high inflation environment. There could be an unraveling of financial conditions. There could be a turnaround in the labor market starting next year. And there could be more caution on the part of consumers pulling back on their expenses, which would make this recession a bit deeper. And we have to remember that the context on the policy front is one that's likely to be less supportive of economic activity. We're not going to get a big bailout for Congress in this high inflation environment.
So it's hard to get a handle on what's going to happen. It's also hard to get a handle on what's actually happening, especially when you take a look at housing prices. And I go there because Vasilios Giannakis was talking about that being a massive driver of currency differentials and growth next year. I'm looking and I'm waiting for the S&P CoreLogic Case-Shiller 20-city composite city house price. I just wanted to do
you
that.
can't even say the full name of that data without laughing anymore, can you?
You've absolutely blown it for me. They do need to rebrand. We'll get your view, Greg, on what they should rebrand to. But how quickly is this housing market in the U.S. deteriorating, and how much further do you see it going?
I think it has some further downside in terms of overall home sales and then housing starts that are likely to follow suit. We are in an environment where the affordability of homes has deteriorated quite sharply. That is preventing new home buyers from entering the market. It's making investors think twice about entering the market. So we're likely to see this ongoing weakness in the housing market, which will feed over time into prices. I think one key element that we have to highlight and note the possibility is that while inflation persistence has been the key theme for the last 18 months, we should be careful that in an environment where economic activity is slowing globally, and when some of these sectors are actually turning around fairly rapidly, there could be more of a drag on inflation going into next year, and we could be in for a faster decline in inflation in the back end of next year. And I think that's something to pay close attention to, especially in this context where you have a lot of uncertainty regarding monetary policy.
It's a dangerous game wherever there's confidence in the global economy over the last couple of years, that's for sure, Greg. Is that the point that you think we should be most humble about going into 23?
I think that's absolutely the point. I mean, we're talking about a framework of navigating this world of uncertainty here at EY, and we're advising our clients to look at multiple scenarios. Having one key baseline is not enough in the current environment. You really need to look at a multitude of scenarios that could unfold over the next 12 to 24 months. If you have built that resilience to navigate this world of uncertainty, then you're going to be better equipped to take advantage of whatever conditions appear over the next 6 to 12 months. It's not about banking on one specific scenario. It's being prepared, resilience on the talent front, resilience on the organizational front, on the pricing front. All of these factors are very important to be able to navigate this highly uncertain and highly volatile macroeconomic backdrop.
What's the one consideration, Greg, heading into 2023? Is it China reopening? Is it the price of energy? Is it the war in Ukraine that really sets some of your base cases?
Well, it's really lying at the intersection of macroeconomics and geopolitics. We are in an environment where when you look at what's happening across the world in China with the zero COVID policy, with the political reappointment of President Xi, when you look at what's happening in the property sector in China, that is having a big impact, not just on China's economic activity, but also on the broader context in Asia. If you look at what's happening in Europe, we still have elevated tensions, and that's feeding into the energy complex, that's feeding into the food complex, it's feeding into the supply chain strains. And then when you look at what's happening in the US, you also have this intersection of political developments and economic developments. And all of those combined make for this very uncertain environment. So there's not necessarily one pocket of risk that we have to monitor. It's really monitoring the whole spectrum of risks around the world, and the intersection of geopolitics and macroeconomics is really the key to understanding the outlook and making sure you're well equipped, well prepared to navigate that environment.